Hi, Mike. Thanks so much for joining me today.
Thanks for having me.
Yeah, so I want to talk a little bit about what's going on with Affirm. So, Affirm beat expectations but issued pretty weak guidance. Could you talk about what drove that cautious tone and just get a little bit more into the detail behind that decision?
Yeah, well, first, we had a really great quarter, as you mentioned. We saw the third quarter of accelerating GMV growth, so consumer demand very strong. Our credit outcomes continued to be right in line with where we needed them to be. We posted really strong unit economics, still above our long-term range of 3 to 4%. And we, continue to drive a lot of operating leverage in the business with meaningful year-on-year improvement in profitability. So feel really good about where the business is at. The business top line, we think about GMV as the ultimate top line of the business, accelerated over the past 3 quarters and continued that acceleration inside of the third quarter, where we saw 40% growth in our last month. And that continued into the first month of the quarter that we're in right now. And we noted in our letter that while we are seeing that trend in a really favorable way, we wanted to be careful about how we thought about the durability of that trend for the next 2 months, simply because we weren't able to identify exactly how much was macro driven and how much was all of the work that we had been doing and accelerating the business throughout the course of the year. And so we wanted to be thoughtfully cautious. But the business is, from our standpoint, could not be in stronger position. We have real consumer demand. We're capturing the trends that are long-term and durable here. And we're doing so in a way that's really sustainable with really strong units and great leverage.
Yeah. And so, for people who are listening who might not be totally in tune with what Affirm does, could you talk through what GMV is, like your business model, just sort of like the bread and butter of
Yeah,
Affirm?
of course. Thanks. So stepping all the way back, our business helps consumers pay for things that they want and need, and we help merchants drive better sales results. And so we think about the volume in our business as the total transaction volume that we help facilitate. So every time a consumer logs onto one of our merchant partner sites and completes a transaction through Affirm, that adds to our gross merchandise volume. That is the total volume on the platform and ultimately a measure of the breadth of our network. How many dollars are we transacting on the platform? We then get compensated for that. We get compensated for that from the merchants in the form of merchant discount rate and from consumers in the form of interest on the loans that we facilitate that have interest. And then we have some costs in our business associated with things like funding costs and credit losses. And that nets out to we call that revenue less transaction cost. That's the kind of our take of that number. And that's what I was mentioning before about that number being above our 3 to 4% range, which is a really good sign about the health of the volume on our platform. I think the thing that investors really should pay attention to is people like Affirm, companies like Affirm, who can control credit outcomes and deliver differentiated results. It shows up in the margin of the business. And that measure grew 53% year on year last quarter, which is a remarkably good sign for the health of the volume on our platform, and in turn for the health of the consumers who are transacting with Affirm.
Yeah. And when you say health of the consumer, like a lot of people worry about the buy now, pay later space, like perhaps it's, not always serving the consumer to the best need. So can you talk more to like the consumers that you all serve and how BNPL might not, be this extractive mechanism?
Yeah, I think buy now, pay later is a really inapt descriptor for the category. That it's kind of a catch-all bucket today that captures a number of players and products that have a very wide set of practices. As a small example, Affirm announced recently that we were going to begin furnishing to the credit bureaus all of our loans. And that was a decision that we took because we're highly invested in the credit reporting system. We care a lot about what our product does for the consumers' credit scores in their lives. And we are leading from the front on that. Some of our competition, I don't think, are going to have the same approach, which is why I think it's really difficult to think about us and our competition in the same lens. And to that point, the consumers that we serve tend to be very representative, at least in the U.S., very representative of the middle of the road consumer. So I think a lot about talking about teachers and firefighters and truck drivers and right down the middle American consumers. not so much young, unemployed, highly credit fragile consumers, and admittedly also not the coastal elites working on Wall Street. It tends to be very representative of the center of the road American household, and that's very different. If you look at some of the rest of the industry, the kinds of credit and income distribution that are served tend to be a little bit more of the credit vulnerable populations. Our consumers are credit aware. They're some of the most credit savvy customers out there. They're very aware about how credit works and how it works for their life, and understand the value of an honest and simple product that we serve. Our product doesn't have any of the traps of revolving debt that you might see with a credit card. So you can't get onto that treadmill and never get off of it. Our loans amortize very quickly. That is a fancy way of saying these loans are designed to go away. We talk a lot about payment volume as a really healthy indicator on our platform. As consumers are paying the loans back on a faster schedule than our already very fast schedule, it suggests that the consumers are definitely in control here. And that's the case that we're seeing right now. And that is different than what you might see from some of the other players in the space. And that's not an accident. Our product needs underwriting. It needs capital markets execution. It's really complicated, the kind of work that we have to do. And a lot of our competition just offer a pay in 4 product. And the pay in 4 product doesn't require as much underwriting in our competition, doesn't require capital markets execution. There's no check on the quality of loans they originate. And as a result, their susceptibility to some of these criticisms, I think, is a little bit higher than ours.
Yeah. Definitely the financing a private taxi for the burrito sort of thing. But as we're looking at the state of the consumer right now, like you all, issued weak guidance, we're getting some data about consumer confidence being quite low. The people that you're serving, these teachers, these firefighters, what do you see with how they're spending their money, the rate at which they're spending money? Is that part of the reason for this weaker guidance as well?
Yeah. At the risk of I don't think our guidance was weak. I think our guidance was actually pretty strong. I think we're still posting real meaningful GMV growth, well north of 30% growth. And I think any business like ours that's growing that quickly is I would not use the word weak at all to describe it. I think there may be some mismatched expectations with some analysts, but I think that's a very different thing than weak guidance. I think on any absolute scale, we're growing at many multiples of US e-commerce. But the things that we are seeing all point to really strong signs of health. One of the trends we pointed out on our call is that the tax refund season was actually stronger than we had thought going into the call. And we saw that in additional payments on the platform, i.e. repaying loans. That's a really good sign for the health of the consumer. We're also seeing really strong engagement across a lot of categories. And some of those are definitely tariff or macro-driven categories, but most of the volume that we saw was very broad-based, including things like domestic travel, which is really not a category we saw impacted at all by any of the macro news. If anything, that was a category that a lot of folks were worried about having some demand pressure on. And we're seeing strong uptake in those categories as well. And so, there's really no signs that we see in our data of any stress on the consumer. And it's something that we admit is a bit of a paradox. If you look at our data, you look at the results of the consumer right now, it suggests everything is great. We have strong employment, strong wage growth. You have a consumer who's out shopping and spending on our platform. In our particular world, things look very good. And yet you look out and you look at sentiment, and it could not be worse. And we aren't macroeconomists here at Affirm, and the duration of our asset allows us to operate the business a little bit differently. That is to say, it's super short in duration, so we're not having to look out a year or two and make those kind of projections. So we can look at what's actually going on in the business and just that. And when we do that, we see that the business is continuing to deliver to the expectations from a credit result standpoint, and the demand continues to be very strong.
Yeah. So there's a lot of calls for a recession potentially. I think the probability has been lowered by Goldman now that we've gotten some relief from the tariffs. But for you all, because you have this shorter duration window, are you kind of like, well, we're just going to go quarter by quarter, month by month, and, not really worry about what could be down the road? Or how do you think about planning for the long term?
It's a great question. I would not use the word worry, because we don't spend a lot of energy thinking about things that we can't control. And the macro is a good example of a thing that we can't control. But we want to be ready and be reactive to it. And so I wouldn't say we go quarter to quarter or month to month. I would say we go day to day. I mean, we are hyper vigilant on our credit results on a daily basis, making sure that the loans that we originate are performing with a credit standpoint consistent with what we thought going into the volume. And so with the way that works mechanically is, 34 days ago, the volume that we originated, we get our first good read of the quality of the credit outcomes that we had thought were going to happen. And that is the reason why we go to 34 days is because the first payment's due in 30 days. And if you're late 4 days or more, you begin to get put into one of our buckets that we can analyze and think about the probability of that eventually charging off. So we get a really good and timely signal. And every day we're looking at the volume from 34 days ago. And you sum that up over the course of weeks and months. And if those credit results are consistent with what we thought going in, that means our model is still predicting credit outcomes the way it's supposed to, and we continue to operate the business the same way. If we see credit results get worse, if you see, for example, higher delinquencies at that point in time, you can take actions to change the underwriting standards, the down payment requirements, or any of the other levers that we have. And similarly, if you see the credit outcomes getting better, that gives you permission to maybe lean in on things like we have been. For example, we've been really focused on increasing the 0% volume in our business. That is to say, the loans that have 0% APRs. And the strength in those credit outcomes, the strength in the economics in the business is allowing us to be very growth oriented right now. And that's a really favorable spot to be in.
And a lot of people will push back on the 0% APR loans about concerns over the economics of the model and margin concerns. So how are you all thinking about the economics of 0% financing?
Yeah, thank you for asking the question. I laugh a little bit because I think people who are concerned about the economics maybe aren't paying attention to the math. These are really good, profitable businesses for Affirm. When we went public quite a while ago, our business was dominated by 0% loans, and we were operating above our long-term margin target range. We were above that 3 to 4% range. And so these loans are exceptionally good for the network. They attract really high quality credit consumer. There's lower credit losses on these loans, and they're still very profitable. What is the case in a business of our scale and with our growth rate, though, is sometimes if you mix a little bit towards 0% like we did this quarter, it can provide a few bips of margin compression. And instead of 4.25%, we did 4.2% or numbers like that. And those kind of compressions get hyper analyzed. And all of a sudden now people are extrapolating small basis point trends, and they're kind of missing the forest. The forest here is our margin in the business is above our long-term trend. So we would advise the market that we think that we're still above the level with which we want to be at the business. We still, despite the fact that we had a healthy mix of 0% loans. And that's because the 0% model is one that says we will earn a fee for facilitating the transaction from the merchant. And that fee is earned at the time of the origination. And it attracts a higher credit quality user, less credit losses in those loans, generally speaking. And that's a really favorable spot because you're not as reliant on interest income on those loans. Puts you in the driver's seat a lot in terms of how you can control credit outcomes. When you pair that with the short duration of our portfolio, it's a really favorable spot to be in. So yeah, for what it's worth, we feel very strongly that that's a really healthy sign of the network. Could not be more happy about it. And the economics are great.
Yeah. No, that's great to hear. It's important because there's a lot of predatory financing out there. But you all have a new partnership with Costco. So why was the retailer a strategic fit, and what sort of partnership does that entail?
Yeah, we have a lot of admiration for who Costco is, mostly because of their obsession with their members. And, where Affirm has the best partners out there is whenever we have a common and shared ethos around who we serve. And Costco is very clear about who they serve and how they wake up every day delivering value to their members. And that it just oozes out of their culture when you meet with them. They're so focused on it, and there's nothing to get our product org more excited than working with partners who wake up every day trying to solve problems for their members, because that's what we do at Affirm. And the process definitely took a long while. And we've been in talks with them for quite a long time. Could not be more happy to partner with an organization that has the same focus on their members as we do on our users. And so if you're an Affirm consumer and a Costco member, it's a perfect match. And it's available on Costco.com now. In fact, I did a transaction last week. I think it's really important to test the product. I'm one of our largest users of the product, and I was really excited to see it and encourage all the listeners to go check it out.
Yeah, go to Costco. I think they have their inflatable pools out now. So
yeah, it's that time of year. It got up to 100 degrees here in Austin. So yeah, you probably
Oh my gosh. Wow. Yeah. Can you talk about how that could impact GMV, like how you're thinking about the business? Like Costco is huge. Like that's a gigantic partnership, and people buy inflatable pools, which are very expensive products from Costco. So could you talk about how that is going to perhaps expand the business?
Yeah, Costco they serve such a wide set of transactions that obviously we're not going to be relevant for everything they do, but we're going to be relevant to the larger considered goods that are purchased there. And that's so great for us. It's right in our wheelhouse. We really believe that Affirm is one of the best ways to pay for things over time whenever you have some consideration, whenever you're thinking about the purchase. And we see that in our data too, when consumers are thinking about how they're going to pay for an item when they're browsing or picking the item. It has a much more favorable outcome for us and for the merchant. And so I think that's the sweet spot, and Costco obviously does a lot of business there. The partnership today is online only, so it's starting there. So while we're really excited about it and it will be meaningful to our business, it's still going to take a while. One of the things about Affirm that we like to remind all of our investors about is we're pretty big now. And so it takes a while for even really big partners to be material to the business. And that's okay. It's actually a good thing. It means that we don't have a ton of concentration risk, even when you onboard such a large partner as Costco. And again, I think when you have a partner like Costco who's as focused on the members as we are on the user, it creates this great opportunity for us to invest together, so we can think a lot about how the product is going to roll out and deliver as much value to the consumer over time as possible. We're very, very early. We just barely got live. And so my guess is this will take many quarters, if not years, to play out. And that's, one of the great things about Affirm is we go out and we earn these distribution relationships, whether that's with a partnership with Shopify and Shop Pay Installments or with Amazon. And then that gives us the right to begin to go do work, right? That's just the start of the work. And Affirm's product is such that we have so many things to work on. So we're just pretty excited to get to work here and to begin to prove that we can add a lot of value to their members.
Yeah, that's amazing. So this will be my final question, which is not years in the making. It's more, what do you think is going to happen this year? So the Federal Reserve, of course, everybody's waiting for this next interest rate cut. So what do you think could happen there? Like, what are you all watching from the business side? How are you thinking about the Fed? I know you said you don't really think about macro, but.
Yeah, well, we definitely keep an eye on it because it impacts us, but we're not. We think our business is one that can navigate any macro environment. We're earning really strong unit economics in this higher rate environment. We feel like we have all the tools to manage any credit environment. And the most important thing for us is to keep an eye on our business and not try to stress about the things that are away from us, because they're really hard to figure out. The tea leaves around how the Fed is going to respond. If it were just looking at the macro data is probably pretty easy to look at and scenario out. The complicating factors, of course, the dynamic relationship of fiscal and monetary policy and everything going on right now from a policy standpoint is just, it creates uncertainty. And for us, that uncertainty isn't cause for panic or alarm. For us, that uncertainty is cause for staying the course. Until we have a good sense of how it will go down, we're not going to amend our approach. So I don't really know. I'll say this, though, if the rates stay higher for longer, that's great for us. Our business is really well suited in this environment, and there's nothing about the rate environment that needs to change for us to continue to post really strong unit economics. Obviously, if rates come down, holding everything else constant, that's a tailwind for our business. But we're probably more concerned with the state of employment, and I know the Fed takes that mandate very seriously. And to that extent, I would be welcoming of the Fed being patient here and only thinking about rates as a way to help in response to any sort of pressure on employment. But for what it's worth, the best indicator of macro from my standpoint is how our team is able to execute in the capital markets. And so we go out to the ABS markets, we get a very real and very direct read from the market about our asset and the state of the credit market's understanding of our asset and willingness to fund it. And we did a deal a few weeks ago, and it was extremely well received, meaningfully oversubscribed. And it was another in a long list of deals that suggest the capital markets, while they're also reeling with the uncertainty and trying to figure out how to navigate things, they look at our asset, they think it's pretty valuable. In these uncertain times, we can bring them certainty. We bring them certain credit outcomes and losses. We bring consumers certainty about how much these things will end up costing them. And that the power of our model is whether you're a capital markets investor or a consumer or a merchant, we're bringing you something real and valuable, especially in times when you're not sure about everything else. So, we're not macroeconomists, can't predict what the Fed will do, but we're not waiting for them to do something to continue to scale our business.
Yeah, no, it's probably smart. Nobody knows what's going to happen tomorrow, much less a couple months from now. So thank you, Michael. This was so interesting, and I really appreciate the conversation.
Thank you so much.